Welcome to another stage analysis video. It's Sunday the 19th of March 2023. I'm going to get through a number of things in tonight's video, going to go in a little bit of a different order than normal. So I'm going to start off by talking about some different types of market breadth, as with the underlying weakness that we're seeing in the market currently. It would be really obviously useful to go through the different types of market breadth that we look at on a weekly basis in the on the Stage Analysis website. I think, as far as I'm concerned, the market breadth is the most important part of the Stage Analysis method. It's the really useful in order to help with both market timing and helping with strategy. So we start off with the bell curve, bullish percent, as well as the broader market breadth measures, and then get into the indexes, have a look at what's going on in the industry group relative strength rankings, what's been moving, obviously what's been strengthening, what's been weakening, for looking at some of the watch list stocks, Bitcoin continuing its stage 2 advance, and Ethereum attempting to move out into stage 2 as well. So have a look at that later in the video as well, and cover the stage analysis technical attributes indicator that I did a post on Thursday that I'm going to be trying to incorporate into the website at the moment, but it's still being built. So I'll discuss that at the end of the website, as we've been working on that for the last 3 months with a developer. So hopefully that'll be coming to the website soon, but still a bit more work to do on that yet. Okay, let's get started. So IBD industry groups, bell curve, bullish, using the bullish percent scores for each of the groups. So get these from Investors Intelligence. They actually have 200 groups, which is 3 more than the MarketSmith IBD groups. I think they've got 197. So Investors Intelligence obviously doing their own thing with those groups a little bit, but it's been a consistent measure that we've been following throughout the course of the last year, and really useful in terms of showing the basic stages in terms of where they are. So we go from a 0 to 40% level as a rough guide. We use that as the stage 4 zone. 40 to 60% range go from the stage 1 and the stage 3, and 60% plus the groups tend to be in stage 2. So depending on where the overall average is on this chart helps us determine what the stage is of the market without even looking at an index chart. You can see what's going on an equal weighted basis, not a cap weighted or anything like that. It's basically because point and figure is equal weighted by its very nature. It gives us an equal weighted basis of what's going on across the board, and then we get that average distribution. So at the moment, which is at 31.19% and declined a further 7.33% this week, which, if we scroll down here a little bit, you'll be able to see was a drop of 41 groups dropped into stage 4 further than were in the previous week, so another 20.5%, and the increased into stage 4. So stage 2 we decreased by 16, which is minus 8%, and the amount of groups in stage 1 or stage 3 decreased by 24, which is minus 12%. So I think it was the 6th week in a row that this has been declining now. So if we go back we can compare it against 6 weeks ago. So if I flick through, you can see 6 weeks ago, the average distribution was at 60.62% here. So it's been rising for a little while. We'd started to move up. We have started to see some stage 2 breakouts and many groups in stage 1, but we have an average distribution just over the 60% level there. You can see the bell curve as a whole was much more weighted, just slightly to the right hand side of the chart, with 104 groups were in stage 4 at the time currently, and only 24 groups were in stage 4. Currently, you can see we've got 151 groups now in stage 4. So you can see the shift that we've had in this over the course of the last 6 weeks. It's dropped almost 30% since the start of February. So we've now got majority of groups, 75.5%, sitting in the stage 4 zone, and only 38 in the stage 1 or stage 3 zone. So this stage 4 zone, as I said, it could be, because we had a lot of, if we flick back to the 6 weeks ago period, we had a lot of groups that were just attempting to break out into early stage 2 or maybe late stage 1, making up thrusts. So come back to now, when you have an up thrust, it can be the opposite of what we call a Wyckoff spring, and when you get those kind of moves, you can tend to get sharp moves in the opposite direction. So although we had stage 2 breakouts and they pulled back into their stage 1 ranges, A lot of them haven't technically broken down back into stage 4 yet, but they are very weak within stage 1 patterns. They've had some sharp moves back into those stage 1 base structures on heavy volume in some cases. So especially over the last couple of weeks with the banking crisis heating up. So definitely overall stage at the moment is sitting in the stage 4 zone currently, even though technically the indexes are still in quite sitting in the middle of the stage 1 zone. So under the surface, definitely some weakness going on there. If we scroll down and have a look at the groups that are leading on a bullish percent basis at the moment, you can see computer software desktop has moved. We've got 80% of stocks on the bullish percent in that, on a positive bullish percent score in that one. We've got building residential, funeral services, soap cleaning preparation, a few other building groups, electric, semiconductors, equipment in there, machine construction and mining, and a few other software ones in there too. So it's very much changed over the course of the last 6 weeks, but we've now not got any groups up in the 100% level at the moment. But software currently is starting to move into a leadership position in the near term. We move on to the market breadth overall. So this is what we consider to be, as I said at the start of the video, the most important part of the stage analysis method. We want to go through the different types of market breadth that we cover each week. So you can look at numerous market breadth indicators. Stan is famous for looking at more than 50 back in the 80s, and now on more recent interviews he said he looks at even more than that now, potentially up to 100 plus. But the overall thing with it is to actually stick to a consistent process with it and make sure that you obviously use the same indicators on a regular basis and get to know them, and then see what they're doing on an overall weighted basis. So if all of them obviously are leaning towards the negative side, then obviously that's the time to be obviously sitting more on the sidelines or on the short side. And if they're leaning more towards the positive side, then obviously you're going to be much more bullish and attacking the market from the long side. So at the moment, starting off with the percentage of stocks above their 50-day, 150-day and 200-day moving averages combined chart. So this is combined from the NYSE and the NASDAQ composite data. So we look at the short, medium and long-term moving averages of each and combine them into a single chart here. So you can see at the moment this is sitting at only 28.48%. It dropped another 4.7% this week. So we're below its own 50-day moving average, which is this red line through here. So this is what we use as the signal line, and the 20-day moving average, which is this grey dotted line, is used as a secondary measure to help determine whether it's in a more neutral or more positive state. So when we're above the 50-day moving average, this red line here, and we're above the 20-day, then we're in what we consider a positive environment. When we're below the 20-day but above the 50-day moving average here, we're in a neutral environment, and when we're below both, then we're in a difficult environment. So you can see currently we've moved from a positive environment back to a neutral environment. Scroll that up a bit so you can see that. And then more recently we started to drop down into a difficult environment back in the latter part of February there, 23rd of February week. We started to move down into what we consider a difficult environment, and we've been on that ever since. And this is combined with the point and figure chart of this as well, so which gives another way of looking at the same data as when we're in a column of X's, much like the bullish percent index. We consider that to be on offense, and when we're in a column of O's, we're on defense. And we can use the same point and figure statuses as the bullish percent index to determine obviously whether it's on bull confirmed, bear alert, bull correction, bear correction, etc. So when we moved from a column of X's here and reverse back to a column of O's from above the 70% level, that's considered a bear alert signal. So we got that back in early February time now. I think it was on the 9th of February, I believe. It moved to that, and then it's now since this week made a double bottom breakdown. So at the bottom of the range here, we've come all the way from above the 70% level down to below the 30% level currently. So we're now on what we consider a bear confirmed, but it's been declining in a column of O's for 6 weeks now. So whenever you're in a column of O's, as I said, you're on defense. So It's been gradually worsening, and we're now getting down into the lower zone. And because we're below the 40% level here, we're now back in that stage 4 zone. So we have had a quick, sharp move, failed stage 2 attempt and reversal back down into the range, and now back into negative territory again, which, as you can see, the majority of the prior year, if we go back to the line chart for those that don't understand point and figure as well, you can see the majority of 2022 there. So there was in this lower zone below the 40% level, what we consider the stage 4 zone, with only a few brief peaks above it. So from this, we can get the data, the percent above the 20-day and the percent above the 50-day, and this is really helpful and determine what type of environment we're on. We're on, as I said, point of figure bear confirmed status, low equity exposure, cash is the position. It's basically, you can use the bullish percent playbook strategies for the same type of things with this. So at the moment, we're looking obviously a very, very defensive strategy at the moment. Caution remains prudent here, as the market's in a very precarious position. If we look at the distance above the 20-day and the 50-day, you can see we did attempt to rebound this week from a lower position. It's the lowest position it's been since the March 2020 period. And it did rebound a little bit this week, but it was quite weak in the rebound attempt. And on the 50-day, the rebound failed and it actually closed the week at a lower low. So it's actually this period back here, which was late February 2020, is the only time it's been as low as it is currently. Wrong one again. So as you can see there, when coming from a higher level, so it came from a positive level, moved down below the zero line and continued lower. So this point here is the only time it's been this low. We did obviously get reasonably low back in September when it bottomed in September. So obviously, as I said in last week's video, we'll be on alert for an attempt to reverse from these kind of levels, because obviously we are at an extreme. However, this week's attempt to rebound, it attempted it twice, failed, and it ended up the week making a lower low there. So actually dropped a further, what were we at? 26.16%, and we closed the prior week at 22.11. So continued lower there this week. If we look at the individual data, you can see the MOSC has come all the way from above the 70% level and reversed all the way back down, getting closer to that 30% level at the moment. We've got 31.2% above their short, medium and long-term moving averages combined. And then with the NASDAQ, as you can see, it's dropped back down into the lower zone again. So we're now just below the December level there, down to a point that it hasn't been at since around September time now. So again, we've got 25.7% in the NASDAQ. So both very, very weak. And obviously the combined score here only at 28.48%. So we're back in that stage 4 zone, as I said, and on a difficult environment status and on defense on the point and figure chart. We go to the shorter term moving average of this. This is the percentage of stocks above their 20-day EMA. Again, a weak rebound this week. We did see the NASDAQ 100, for example, manage to rebound back out of its range. But the major indexes, what we look for with this is for all 4 of the major ones to get back through this key 30% level. So we'll look for a strong move back through the 30% level and ideally back through the 50% range as well. At the same time, we want to see a strong thrust back through and out of the lower zone. So after you've had a period in the lower zone, you want that strong move, and you want it to happen in the NASDAQ composite, the NYSC, which you can see at the moment is at 14.5%. You want to see it happen in all of these, the small caps, which is at 12% at the moment, and the S&P 500, which is at 22.4% this week. So as you can see, the S&P rebounded a bit, but again, still couldn't close back above that key 30% level there. If one of them moves above the 30% level, that's not a signal in the method from our perspective. It's where you look for all 4 to move consistently at the same time. We want to see this moving in conjunction with price action. If you see the index moving back above its 20-day EMA, for example, and this is still below 50%, then that would be obviously a negative divergence there. So we want to see this leading the price action, not lagging it. So at the moment, still in the lower zone, still on all 4, so remains on a short-term negative signal, continuing to watch for potential reversals, but remains on a negative signal at the moment. So Bullish percent index looked at in a different way. So this is a line chart on an intraday basis of this, which I find very useful. It's got a 30 bar moving average with it. So when you've got the Nasdaq Composite and the NYSE both below this 30 bar moving average here on the intraday, which you can see both were back on the 9th of February here. That's when it reverses to a difficult environment signal or a negative signal. When you get moves back above, you want to see strong moves on both. So you can see we didn't get a strong move on both. In either of these, you tend to get big thrusting bars when it's a breakout move. So we didn't get that during these areas. So at these points in here, it changed to a neutral, which I highlighted at the time. And then we moved back to a negative. So at the moment, with this moving back into the moving average at the moment on the Nasdaq, we're in a more neutral position, still below on the NYSE, but getting closer to a neutral position in that. So difficult/neutral for the bullish percent short-term measure at the moment. If we look at the bullish percent index from a longer term perspective, you can see it made a much lower low this week. So breaking down back below the December low level there. And if we look at it on the point of figure chart, this gives us a different perspective on a longer term basis. So above the 70% level is your upper zone, and below the 30% level is your lower zone. So you want to look for reversals from below the 30% level, and you get higher risk reversals at the top above 70% level. So this year's move didn't get back up above the 70% level, reversed in February down, turned back onto what we call bull correction at the time, because it was on a double top breakout. So it was on a bull confirmed in January, reversed back to bull correction, has now made a double bottom breakdown. So has moved back onto a bear confirmed signal again recently. But again, with this, as with what I was talking about earlier on the moving average version of this, when you're on a column of O's, you're on defense. So any reversal from column of X's to a column of O's doesn't happen very often. So you go from offense to defense based on what column you're in. So, and then we use this as part of the weight of evidence, NYSE, the Nasdaq, S&P 500, etc. So at the moment, we're on defense and we're down to 34.53%. Nasdaq is down to 33.26% as well. You can see this has come off recently, got up to a high of around 55% there, but again is in the column of O's since February there, and started to reverse back down towards the bottom, but it's not yet on a bear confirmed signal. I haven't made a double bottom breakdown, but it's on defense. So that's all you need to know really, whether it's on offense or whether it's on defense. The actual statuses don't matter too much. So whether it's in a column of O's or whether it's in a column of X's basically, and field position. So we are getting down to the lower end of the table here. So reversals from the lower point obviously are much stronger than reversals at a higher level if it's going that way. So we reverse from O's and then you reverse back up to X's from a higher level, then that's much weaker field position. And then if you get a reversal down from the lower zone back out of here, so we did drop into the lower zone down to this, and then we started to reverse back up again, that would be a strong area to get a reversal because you've got plenty of room to run to the upside. On the S&P 500, this has been reasonably good over the last year for short-term signals. Moves above the 70% level and reversals back down again have been very, very good, and out of the lower zone also. So again, if we go back to the point of figure chart here, you can see down into the lower zone now. So we look for a reversal move back up and out. Obviously it could drop much lower yet. We're still in a bear confirmed since this move here. Obviously been on a column of O's since back in early February time. 13th of February this is saying, but it's not always accurate. That would need to go back and check on that to be the exact date, but I'm pretty sure I tweeted it at the time on the reversal, so I can check back through my Twitter feed for that. But yes, from this we look for a reversal back to a column of X's here, and because it's below the 30% level, it would change it to a bull alert signal if it did. So this is a more short-term measure than the NYSE and the Nasdaq composite chart, so it does have reversals from upper and lower zones much more frequently, so a little bit more useful for short-term swing trading in that regard. But we take, as with the weight of evidence approach, we take short-term, medium-term and longer-term measures all as one, and use that information to add to the weighting. So at the moment you can see the vast majority of things we've been looking at so far are very much on a negative weighting, but we have got some getting down to more extreme levels here. NASDAQ NYSE advanced decline line below its 50-day moving average here, which we use as a little bit of a signal line. So at the moment, this is on a negative signal. If you look at the NASDAQ version of this, you can see that's below its 50-day MA as well. It's been very weak for the last couple of years here, so continuing to remain weak below that 50-day moving average. So again, on a negative signal there. We look at what we call the momentum index of this. So in Stan Weinstein's book, he talks about the advanced decline line momentum index, which is actually based on the 200-day simple moving average. So there is a faster version of this, which you can do using whatever MA you like. I prefer the 10-day moving average version of this. It gives very similar signals to what you get from the McClellan oscillator. So this, as you can see at the moment, since the start of the year, we're now breaking down to lower lows here. Again, since the start of the year, lower lows on the NASDAQ and the NYSE. So, but we aren't quite yet at extremes, but we are getting down to lower levels. So I've expanded this out a bit, add a few more years into this. You can see back in 2020, we did actually reach much lower level. And even last year, we reached a lower level on this twice in the NASDAQ. So it's not quite yet at an extreme, but it is at a point where we've had some short-term reversals. So again, we're on alert in the short term for reversals, but just because something's at an extreme doesn't mean it can't get more extreme. So the trend is obviously remains negative on this at the moment, but obviously be alert for those changes. And then if it does swing back up, obviously a positive status of this is when it swings back up and through the zero level on here. McClellan oscillator, similar picture at the moment, attempted to rebound this week. So managed to pull up a little bit higher there from the level that it got down to in late September there. If we look at this is the NYSE version, NASDAQ version doing pretty much the same. So got down to a level that it reversed that multiple times. But again, it could get a lot more extreme than that. This is only, let's take it back a few more years. So you can see there have been many times where it's got to lower levels than it has done currently. So try to avoid near-term bias, basically, by only looking at very short-term charts. You need to take your scale out a little bit sometimes to see what's possible, because when something looks extreme, there's always that chance it could get worse, and there's normally going to be a historical example of that's not too far away from the present that you can find. So on this, you can see there's multiple times where it's got worse only in the last 6 years here. So this isn't, although it's got to an extreme this week and rebounded, it could quite easily get to a lower level here, and the summation index remains on a negative signal below the zero line. MA crossovers for this 10 and 30 day EMAs. So signals are when it crosses to the 10 crosses the 30 to the upside and 10 crosses the 30 to the downside. So at the moment on a negative signal in the NYSE, and same with the NASDAQ, both on a negative cross since February. New high, new lows. The new lows started to pick up again recently. So we've actually we had 199 on Friday again, and only 13 new highs in the NYSE. NASDAQ 340 to only 35 new highs. So very much weighted to the downside. If we look at the cumulative line, it's crossed back below its 50-day moving average, which has been a useful long-term signal over the years. There's not many times where it crosses above and below. So at the moment in a fairly neutral position, but below is more negative and above is more positive. But this is a long-term signal. So at the moment, obviously, until it makes a lower low here, we give it the benefit of the doubt that it's in a more neutral position at the moment. But on the 5-day average, we have dropped back below the zero line recently. So the recent spate of breakout attempts, new highs, have quickly reversed, and we're making more new lows in a very short period here, and we've actually broken below the level that we got to in December there as well. So again, on a more negative signal as well. A more custom breadth chart we do on the Stage Analysis website is the percentage of stocks above their +1 ATR level and percentage of stocks below their -1 ATR level. So you can see here from this, the greater than 1 ATR level indicates short-term uptrends. So we do this in the S&P 500 for a consistent measure of small, medium, of small, large and mid-cap stocks. So at the moment, we've got around 5% of stocks at the moment on a above their 180R level, plus 180R level. So that means they're in a short-term uptrend. And we've got over 66% here below their minus 180R level, which means they're in a short-term downtrend. So you can see by these levels here, at the moment we're using the 50% level for the upper zone. I need to get more data for this back through the years. When it got back to 2021 at the moment. So I'm going to go back and do some further back testing on this and see if the level needs to be changed a bit. So obviously we've got from the 50% is actually the midpoint. But in terms of short-term spikes, it tends to be when we reverse above the 50% level, you then wait for a reversal back down below the 50% level. And then on the other chart, you wait for a reversal back through the 10% level. So you want to see both of these at the same time. So above 10% on the plus 180R level and below 50% on the minus 180R level. And that's when you start to tend to see reversals happening. But at the moment we're holding in a negative position. From a cumulative basis, you can see we've been on a negative signal for a good few weeks now, since mid-February time. Another custom breadth chart we do on the Stage Analysis website is the cumulative point and figure breakouts minus breakdowns. So this is something I do every day based on the point and figure breakouts, double top breakouts and point and figure double bottom breakdowns. You could in theory do this for any market. I'm considering adding some more markets for this, as long as you've got the data for the point and figure breakouts, and you can do it in a consistent way. You can obviously chart that data. It gives again an equal weighted way of looking at what's going on, as it literally is every stock gets one vote, and it's based on whether it's on a point and figure buy signal or not. So you can then chart that, give it a moving averages. So we've got a 200 day, a 50 day, and a 20 day moving average on this. So you can see we've dropped back below that 200 day moving average, which we've got back above recently, but it's back in February time started to drop below that. If we look at the short-term measure of this, so this grey line here, the 20 day moving average, this is the zero line on this chart. So this is a flattened version of the 20 day moving average, and then the cumulative line relative to that 20 day moving average. And on this, we use the signals, moves above its own 20 day moving average and below its own 20 day moving average. So you can see at the moment we've been on a negative signal, which was back on the 9th of February, I believe, again. So multiple short-term market breadth measures turn negative on the 9th of February, and then we started to see some of the more intermediate and the longer term measures as we move towards the latter part of February, 22nd to the 24th. I think the bullish percent started moving down. So at the moment we remain on a negative signal since the 9th of February, so on a difficult environment status for the cumulative point and figure breakdowns. So if this can start to move back through its moving average here, then that would potentially give us a short-term positive signal on that and return it back to a positive environment. But at the moment, we remain on a difficult environment on a negative signal towards the weight of evidence. This is the momentum indexes for the point and figure breakouts minus breakdowns with a 10 day, a 20 day, a 50 day, and a 200 day. So you can see 10 days back in the lower zone, 20 days in the lower zone, 50 days reversed lower, but still above its zero line. And the 200 days reversed recently and still holding below the zero line. But we did have a change of behavior back from the October low back into the February high there. So we have seen a short-term change over what we've seen over the last year or two there. So starting to look a little bit more positive, but could easily get negative again here as the short-term measures have obviously turned negative. So from an overall perspective, the weight of evidence is very heavily weighted to the negative side at the moment, and with the bullish percent bell curve at only 31% at the moment in the stage 4 zone. So although the indexes are not in stage 4, the underlying data is very much in stage 4 at the moment. So we just need to be incredibly cautious, as the market is in a very precarious position based on the underlying data. So